Hello friends, welcome back. Welcome to JK Shah classes. Today we will be revising the chapter Alternate Minimum Tax AMT chapter 12 BA. This chapter is applicable for inter CA also apart from final CA. We are revising it from final CA point of view. 5 sections, chapter 12 BA, section 115 JC, JD, JE, 115 JEE and 115 JF. Before we proceed further, let me tell you this chapter is more or less on the lines of minimum alternate tax. Before we actually start with this chapter, let's make a brief comparison between the provisions of minimum alternate tax and this particular chapter. Minimum alternate tax is chapter 12B. This is chapter 12BA. Minimum alternate tax has two sections, section 115 JB and 115 JAA. 115 JAA on MAT credit. This chapter will have 5 sections, 115 JC, JD, JE, JEE and JF. MAT was applicable only to companies. This chapter applies to all persons other than companies. If you recollect, MAT chapter, there were some exceptions. MAT does not apply to those companies which have opted for 22% tax rate and 15% tax rate under section 115BAA or under 115BAB. Here also similar concept. But since this chapter applies to persons other than companies, here this chapter will not apply to those who have opted for 115BAC, that is new tax regime, subsection 1A. Individual HUF, AOP, BOI and AJP will also not apply to cooperative society which has opted for 115BAD, 22% tax rate and 115BAE, 15% tax rate. That point will come. So naturally, government is giving one lollipop that if you opt for special schemes, new schemes, then we will not apply minimum alternate tax for companies or we will not apply AMT for other than companies. Next point is in minimum alternate tax, the tax payable was higher of the two. Here also tax payable will be higher of the two. But since the chapters are on similar lines, the government, in order to distinguish between the two chapters, has used a slightly different language. For minimum alternate tax, it says tax payable will be number 1, normal income tax plus surcharge plus health and education cess, normal tax calculated as per normal provisions of the Income Tax Act or 15% of book profit. Here the language is normal tax and book profit. Same kind of concept here but with a slightly different language. Here instead of calling it as a normal tax, we call it as regular tax. Regular tax payable as per regular provisions of the Income Tax Act. Of course, here also plus surcharge plus health and education cess. Here also plus surcharge plus health and education cess. Surcharge will be attracted in case of companies only when the normal income exceeds 1 crore or 10 crore. And AMT chapter, surcharge will be attracted only if net income exceeds 50 lakhs, 1 crore, 2 crore, 5 crore and 10 crore. However, instead of 15% the rate of minimum alternate tax, here the rate is still 18.5%, 18.5% of adjusted total income. For MAT we say of book profit, here we say adjusted total income ATI. Instead of 18.5% rate will be 15% if assessee is a cooperative society and the rate will be 9% in case if assessee is a unit of International Financial Service Center plus deriving income entirely in foreign currency, forex, then 9%. Of course, plus surcharge plus health and education cess. Here surcharge will be attracted if the normal income exceeds 1 crore or 10 crore and here surcharge was to be attracted if the book profit exceeded 1 crore or 2 crore. Similarly, in this chapter, while computing regular tax, surcharge will be attracted if the regular income, that is NTI, net taxable income, exceeds 50 lakhs, 1 crore, 2 crore, 5 crore. And here book profit, instead of book profit we use adjusted total income. Here surcharge will be attracted only if adjusted total income exceeds 50 lakhs or 1 crore. Next point of distinction is CA report to be furnished in form 29B for MAT, here form 29C. Both the places time limit is same, 1 month before the due date of filing IT return. Here MAT credit is allowed for 15 years, here AMT credit will be allowed for 15 years. Section number will be different, concept ideologically same. Here the starting point of this chapter in minimum alternate tax, starting point is net profit as per books of accounts, that is net profit as per statement of P&L. What I mean to say is that starting point, the starting figure is as per books of accounts. Whereas in alternate minimum tax, the starting point is as per Income Tax Act provision. We have to start with NTI, net taxable income. Of course, you know pretty well net taxable income plus add back 3 items. Chapter 6A deductions under heading C, deduction under 35 AD, specified businesses, capital expenditure for 14 specified businesses, and the third one is deduction under 10 AA. AMT applies to every person other than company, but it does not apply to certain people. Provisions of AMT apply to all persons except of other than company, so it does not apply to company. Secondly, it does not apply to individual HUF, AOP, BOI, AJP, these 5 people, if the net taxable income may be more than 20 lakh, but if the adjusted total income does not exceed 20 lakh rupees. 5 people who enjoy basic exemption limit, individual HUF, AOP, BOI and artificial juridical person whose adjusted total income does not exceed 20 lakhs, then AMT will not apply. AMT also will not apply to specified fund under section 115JEE subsection 2A. Specified fund means the one which is referred to in section 10(4)(d). Referred to in section 10 clause 4D. What is specified fund and how different it is from FII? I had already explained it to you in special rates of tax chapter 12. Let me explain it to you once again. Alternate minimum tax, say this is India, this is USA. FII is the one which is registered in USA only, incorporated in USA, that is foreign country, and has its investors P, Q and R. All investors are non-residents. Investors are also localites of residents or localites of USA. Whereas specified fund referred to in 10(4)(d) is the one which is incorporated in India under Companies Act or maybe as a trust or as an AOP or as a body corporate, and it has investors located outside India. A, B and C are residents of USA. So the common point between FII and specified fund is that they both come to India for investment and both of them have their investors located in USA or foreign country, residents of foreign country, or are non-resident in India. The only difference is FII is incorporated outside India, whereas specified fund is incorporated in India. If it is specified fund, then AMT will not apply. AMT will not apply at all. Coming back, also will not apply to individual HUF who had opted for new tax scheme under section 115 BAC subsection 5. Now this particular point is no more applicable. This is new tax scheme up to AY 23-24. AY 24-25 onwards, the new tax scheme or the new tax regime NTR has become default scheme. So for them we have the next point, individual HUF. Now it is applicable to all the 5 people, individual HUF, AOP, BOI and AJP. AMT chapter will not apply to these 5 people if income is computed under new tax regime as per 115 BAC subsection 1A. So third point stands cancelled. I have not even covered in your notes given to you. The last one does not apply to resident cooperative society which has opted for 22% tax rate under 115 BAD or 15% tax rate under 115 BAE. 22%, 15%. AMT means applies to all persons other than companies but does not apply to specified person, resident cooperative societies who have opted for 115 BAD, BAE, individual HUF, AOP, BOI, AJP whose income is computed as per new tax regime. So these 3 people will not apply, and you can say does not apply to companies also, so totally does not apply to 4 people. 115 JC is the main section, says applicable, this chapter applies to every person other than a company. Tax payable shall be higher of the following two, either regular tax payable which is to be computed as per regular provisions of Income Tax Act plus surcharge plus health and education cess wherever applicable, or second thing to be computed is 18.5% of adjusted total income. Be careful, minimum alternate tax MAT was also 18.5% of book profit. There it is brought down to 15% couple of years back, but here 18.5% has been kept intact. Of ATI plus surcharge if income exceeds, that is ATI exceeds 50 lakhs or 1 crore plus health and education cess, this is AMT. Now surcharge rate will be 0, 10, 15, 25, 37 depending upon who the assessee is. If it is partnership firm then 0% and 12%, LLP then 0%, 12%, individual HUF, AOP, BOI, AJP then 0, 10, 15, 25, 37. According to 115 JB, we had calculated book profit. Here it is 115 JC subsection 2, how to compute adjusted total income. Adjusted total income is net taxable income as per Income Tax Act. Increase further by 3 things. That's it. Technically, chapter is over. Number 1, deductions claim under heading C of chapter 6A. Heading C would meaning thereby we don't have to add back all chapter 6A deductions, only heading C, which will have 12 deductions or 12 sections ranging between 80 IA till 80 QQB RRB. Ideally, income linked deduction or profit linked deduction. Number 2, add back deductions claim under section 10AA SEZ Special Economic Zone. For 15 consecutive years, deduction is allowable, which I will briefly recapitulate, and deduction claimed under 35 AD. 35 AD means capital expenditure on 14 specified business, laying and operating cross-country pipeline network, warehousing facility for storage of agricultural products, cold chain facility, hotel of 2-star and above, hospital with 100 patient beds and more, semiconductor wafer fabricating manufacturing unit, new infrastructure facility, housing project under slum redevelopment, housing project under affordable housing scheme, production of honey or beeswax, production of fertilizer, etc. 35 AD we will discuss, but if you observe, everywhere it says deductions claimed, in the sense if these 3 are claimed, then only AMT will be applicable, then only these 3 are to be added back. If these 3 are not claimed, then they are not to be added back. So adjusted total income means increase by NTI, increase by following 3. First one is chapter 6A under heading C, that is deduction in respect of certain incomes, which all 12 sections will be there. So in your notes also I have mentioned 80 IA, 80 IAB, 80 IAC, 80 IB, 80 IC, ID, IE, 80 JJA, 80 JJAA, 80 QQB and 80 RRB. However, 80 TTA and 80 TTB savings account interest up to 10,000, 80 TTA savings account interest up to 10,000, and 80 TTB is for senior citizen, resident senior citizen, for any bank account, interest from any bank account up to 50,000. This one is up to 10,000. This one is up to 50,000. They are not considered as part of heading C. For these 2 sections, government introduced heading CA. That's why they are not to be added back. What is to be added back is only deduction under heading C. So deduction under ATC, ATD, Mediclaim, LIC, PPF, all those things not to be added back will be allowed intact. Okay. But chapter 6A heading C, so these 12 other than under section ATP. ATP is exclusively for cooperative societies. 6 types of incomes of cooperative societies are eligible for deduction. ATP deduction already claimed not to be added back. Let it be intact. Only these 12 to be added back. The next one is deduction under 10AA. As far as 10AA is concerned, for special economic zone, 15 years anybody sets up a unit and exports the goods from that SEZ unit, then deduction is allowed for 15 years. In what percentage? So deduction for 15 years, first 5 years it will be 100% of the eligible profit. Eligible profit to be computed as per this formula. Next 5 years deduction will be 50% of the eligible profit, and last 5 years it will be either 50% of the eligible profit or amount transferred to special economic zone reinvestment reserve account. We call it as special reserve accounts, SEZ reserve account. Whichever is lower will be allowed as a deduction in the last 5 years. However, this table will give you only percentage. Everywhere it is percentage of eligible profit. How to compute eligible profit? That we will be studying here. Eligible profit to be computed as per given formula. Left hand side bracket multiplied by right hand side bracket. Left hand side bracket says total profit. Total profit means total profit of the SEZ undertaking, not total profit of the assessee, but only SEZ undertaking. Assessee may have a business in SEZ as well as business in non-SEZ area. So we don't have to 1 unit here, 1 unit here. We don't have to take the total profits of both the units. For the purpose of this formula, we have to take into account only the profits of SEZ undertaking multiplied by export turnover divided by total turnover of SEZ undertaking, not of the non-SEZ undertaking. Or that is what will give us the eligible profit. Now if you apply in this example, I have taken one example. Supposingly the total profit is 200 lakhs of SEZ undertaking export turnover is 800 lakhs and the total turnover is 1000 lakhs. Now total turnover will comprise of two factors, export turnover as well as domestic turnover. So here domestic turnover is not given, not even required for applying this formula. Simply export turnover is what percentage of total turnover? Answer, 800 divided by 1000 into 100, 80%. So if 80% of the total turnover is export turnover, then 80% of the profit, same percentage you apply to profit, 80% of total profit will be deemed to be export profit. 160 lakhs will be the answer. So 200 lakhs total profit into export turnover divided by total turnover, 160 lakh. 160 lakh is your eligible profit. This eligible profit, answer doesn't end here. On this eligible profit, you apply this formula depending upon whether first 5 years are going on, next 5 years or last 5 years. 115 JC subsection 2 clarifies the meaning of adjusted total income. ATI add back three things. First two are done. Deductions claimed, claimed under chapter 6A heading C other than ATP, 10AA for 15 years and 35 AD. However, as far as section 35 AD is concerned, it is capital expenditure on 14 specified businesses other than capital expenditure on land, goodwill and financial instrument. Land, goodwill, financial instrument, these three will not be allowed. But in 35 AD, once you claim 35 AD deduction, then you cannot claim depreciation. And if you want depreciation, then don't claim 35 AD. 35 AD is an optional provision. Supposingly I acquire plant and machinery, or let's say building which has a rate of depreciation of 10%. If you recollect PGBP chapter, building is acquired for 100 lakh for specified business. If I claim 35 AD, then I get to claim entire 100 lakhs in first year itself. But then on the other hand, I cannot claim depreciation. 100 lakh will be allowed to me in one go. On the other hand, if I don't claim 35 AD, then I can claim depreciation on the same year after another. But at least in the first year, my depreciation would be 10 lakhs, considering the rate of depreciation to be 10%. So because of 35 AD, if you observe, in the first year, my benefit is not full 100 lakhs. My benefit is not to the tune of deduction claim, my benefit is only to the tune of 90 lakh. Because if I would not have claimed this 100 lakh, I could have claimed depreciation otherwise also. So my benefit is differential amount 90 lakh. Then the question is, when I am calculating adjusted total income, why should I add back 100 lakhs as given here in the previous slide? Add back deduction claim under 35 AD, which is 100 lakhs. But whereas my benefit I have taken is to the tune of 90 lakhs. So government says yes, agreed, don't add back 100 lakh, add back only 90 lakh. How to add back 90 lakhs? So it says first you add back full 100 lakhs. Deduction claim under 35 AD, then reduce it by the amount of depreciation which would have been allowable under section 32. Had the deduction under 35 AD would not have been claimed. So depreciation would have been 10, my effective benefit would have been 90, add back only 90. This is an important point, keep it in your mind, institute's favorite point, because here institute can play a game, institute can purposely give you some asset. Here what happens, what I have seen in the students is that 100 they add back because 100 is claimed, but they forget to reduce depreciation. So please apply your mind and add back only 90, keep it in your mind. So these three items to be added back provided they have been claimed. However, out of these three items, just for the sake of your knowledge, the first two items are allowed as a deduction, chapter 6A heading C and 10AA, only if IT return is filed within due date. So is not the case for 35 AD. Belated return also one can claim 35 AD, but for first two, IT return has to be filed within due date. IT return is filed within due date, otherwise they cannot be claimed at all. So keep it in your mind, once question came where institute had given two options, whereby this chapter 6A was involved, heading C, ATIB deduction, where institute gave two variations in the question. First part where assessee files IT return beyond due date, and second part where assessee files IT return within due date. Okay. Now 115 JC subsection 3 on which question not expected. CA report will have to be furnished in form number 29C 1 month before the due date of filing IT return by every person to whom AMT is applicable. If AMT does not apply, then no need to file this. 29C is not mandatory for everyone. It is only for those who are subjected to AMT, those in whose case amount of AMT is higher than the regular tax payable. 1 month before the due date of filing IT return. No penalty for failure, but without this your IT return will not be uploaded only. You need to give the details of date of filing form number 29C, acknowledgement number of filing form 29C in the IT return. Otherwise your IT return cannot be uploaded. You will have to be careful. 115 JC subsection 4, AMT chapter will not apply to 2-3 people, but for 2 of them rate of tax instead of 18.5% will be either 9% or 15%. 15% for cooperative society. Cooperative society, if opting for 115 BAD, BAE, then chapter is not applicable only. But if not opting for these two, then chapter is applicable. But then rate of AMT will be 15% instead of 18.5%. And if assessee is a unit of IFSC, where entire income is derived in foreign currency, in convertible foreign currency, then the rate will be 9% instead of 18.5%. This already came in the exam in the form of MCQ. So these small things also to be remembered. 115 JC subsection 5 says MAT. The way MAT was not applicable to companies opting for 115 BAA and BAB. Same way here, AMT chapter will not apply to resident cooperative societies which have opted for 22% tax rate or 15% tax rate, or individual HUF, AOP, BOI, AJP whose income is computed as per 115 BAC subsection 5 up to AY 20 to 23, or income computed under 115 BAC subsection 1A. Both are new tax regime, but this is up to AY 23-24 and this is with effect from on or after AY 24-25. Both are same only. Earlier 115 BAC was a optional tax regime. Now it is mandatory, that is default tax regime. Okay, then 115 JD, just like AMT chapter, just like MAT chapter, here also AMT credit will be allowed to be carried forward for the next 15 years. When will AMT credit arise? Answer: whenever AMT paid is greater than the regular tax payable. Supposingly AMT paid is 120 lakh including surcharge and health and education cess, and the regular tax payable is 80 lakhs. Then ask a question to yourself that this is regular tax, this is AMT. Both the figures are including surcharge and health and education cess. If this chapter AMT was not there or would not have been there, how much tax would have had to be paid? Answer: tax payable would have been then 80 lakh. So are we paying anything extra because of this chapter? Answer: yes. Because of this chapter we are paying 40 lakhs extra. So that extra amount paid will be considered as AMT credit. In the year in which credit arises, in that year nothing can be done. It can just be carried forward. How many years? Answer: 15 years it can be carried forward for. If not utilized in next 15 years, 15 consecutive years, then it will lapse. Credit can be utilized only when the situation reverses. When will credit arise? Credit will arise when AMT is more than the is greater than the regular tax. Can be utilized only when AMT is less than the regular tax, or rather regular tax is greater than AMT. Next 15 years it can be carried forward. 15 years you will have to remember. Can be utilized or can be set off only against excess of regular tax over and above AMT in those 15 years, whenever regular tax is greater than the amount of AMT. However, credit can be utilized only to the tune of this excess. Only to the tune of this excess. For example, first year, year 1, there is a credit of 40 lakhs arising the way I explained it to you. However, in the next year regular tax payable is 80 lakhs and the AMT payable is 72 lakh. So I can utilize this credit of 40 lakh, amount of credit is 40 lakh, but I can utilize this only to the tune of excess of regular over and above AMT, that is 8 lakhs. Now 32 lakhs will be the credit left out which I can carry forward to the next year and so on. Some points to be noted about AMT credit. Number 1, if AMT credit not utilized in 15 years, it will lapse. Number 2, no interest will be granted for the intervening period. Credit which arose to me in the first year or 0 year, I would say, year 0, I could carry it forward till year 15 and utilize anywhere whenever the situation reverses. However, this happened directly in year 11. I claim credit for the first time directly in year 11. Can I ask for the interest for the 10 years, intervening 10 years, that sir, I paid 40 lakhs extra in year 0, I am utilizing it now, so pay me interest for the 10 years. Answer: no, this is not advance tax where government will pay interest. Next point, AMT amount or AMT credit amount is a derived amount. It depends upon two factors, depends upon regular income tax and AMT. Both of them are right now calculated by assessee. AMT is 120 lakh in our example, regular tax is 80 lakh. That is how we got AMT credit of 40 lakhs. But it depends upon these two figures. Any of these two figures undergo any changes due to order of assessment, reassessment, rectification or any appellate authority or higher authority, then AMT credit shall also undergo changes automatically. No need to do anything. Say this becomes 122, then minus 80 of AMT credit will become 42 lakhs automatically. No need to make any application to anybody. Okay. Then proviso. If you recollect in minimum alternate tax chapter, the way we had discussed about foreign tax credit FTC, same concept applies here also. In MAT chapter, MAT versus normal tax, here it is AMT versus regular tax. Whichever is higher is the amount payable. But in case if there is foreign tax credit available for the taxes paid outside India, for which credit is allowable under section 1990A, if the amount of FTC allowed against AMT is more than the FTC allowable against regular tax, then such excess shall be ignored while computing AMT credit. What does this mean? Same example, same figure. Say AMT is 22 lakhs including surcharge and health and education cess, and the normal tax payable is 6 lakhs. Then which one is payable? Answer higher of the two, 22 versus 6. 22 will be payable. All figures are inclusive of surcharge and health and education cess. At the same time, we have foreign tax credit. So 22 and 6 both were before claiming FTC. Higher of the two is 22, that is final tax payable. This 10 lakhs is the FTC available. How would you have claimed it? So AMT 22. If I would have claimed FTC against AMT, I could have claimed full 10 lakhs. Because I have sufficient amount of tax of AMT available, I could have claimed full 10 lakhs and the ultimate payable would have been 12. Instead of against this, if AMT chapter was not there, then my regular tax is 6 lakhs. How much FTC I could have claimed? FTC available is 10 lakh. I could not have claimed full 10 lakhs. Otherwise, there would be a refund of 4 lakhs. Indian government will not pay refund of tax which is paid outside India. So FTC would be restricted to 6 lakhs, tax payable would be 0. So technically you should get the AMT credit of 12. Amount of AMT ultimately paid over and above the regular tax of 0 is 12 lakh. Difference is 12. Therefore AMT credit should have been 12. However, as per our system, the answer is not 12. As per our system, AMT is 22 minus regular tax is 6 lakhs. And accordingly AMT credit turns out to be 16 lakh. So government says okay, we will not allow you 16. 16 is a wrong answer. It's little higher. You are technically eligible for carry forward of AMT credit of only 12 lakhs. So what to do? So answer here it says find out how much is the excess of credit claim, that is foreign tax credit, how much FTC is claimed or excess FTC claim against AMT over and above the amount of FTC which you could have claimed against regular tax. So against regular tax, if this chapter was not there, then I could have claimed only 6 lakhs. I could not have claimed entire 10 lakhs. But if since AMT is applicable, I am allowed to claim full 10 lakh rupee. So FTC claimed against AMT 10 lakhs minus FTC allowable against regular tax 6 lakhs. The excess FTC is 4 lakh rupees. So you subtract that from AMT credit. Excess FTC claimed against AMT as compared to what would have been allowable had this chapter not been there, or what would have been allowable out of total 10 lakh FTC, what would have been allowable against regular tax. So 4 lakh is the extra one, subtracted, AMT credit will be 12. Rather, Arun Jaitley ji, the finance minister who introduced it, he could have kept it short and simple. He said you claim AMT credit, calculate AMT credit after claiming FTC. He should have done it this way. Rather than keeping it straightforward and simple where a common man can also understand it, they did it this way, that you calculate AMT credit this way, bring 16 lakh and from 16 lakh you remove 4 lakhs, your answer should be 12 lakh. This is how AMT credit will be computed. First you calculate 16 lakh. From 16 you reduce 4 lakh, the excess AMT credit. Okay. Now out of the so many people to whom AMT does not apply. So answer, AMT does not apply to specified fund, does not apply to companies, does not apply to resident cooperative society who has opted for 22% and 15% tax rate. That is okay. But 115 BSC subsection 1A, new tax regime applicable to 5 people, individuals, HUFs, AOP, BOI, artificial juridical persons. Out of these 5 people, this 115 BSC subsection 1A can be switched over at any time. So if you recollect that special rates of tax chapter, under 115 BSC subsection 1A, we had studied that assessee has an option to go for old scheme also. Under old scheme, AMT credit is available. Under new scheme, AMT credit is not available now. So what to do? So supposingly assessee is under old scheme since ages. Under old scheme, he has AMT credit left out, AMT credit of 7 lakh rupees left out with 12 years of carry forward period available. If he switches over to the new scheme, old scheme to new scheme, new tax regime I call it as, if he switches over to this, AMT credit will lapse. It is clarified. So next year, next to next year, assessee switches back to old scheme, then can he once again bring his forward that okay, 1 year is left out. Financial year 23-24 he opted for old scheme. Financial year 24-25 new scheme. And now in financial year 25-26, that is next year, assessee wants to switch over to old scheme, which may be allowed, may not be allowed, whatever. Can he bring forward this 7 lakhs? Answer, no, 7 lakh cannot be brought forward. Once assessee switches to this new tax regime, this AMT credit automatically will lapse. It does not say that in this year set off will not be allowed. No, it says AMT credit will lapse. Unavailed AMT credit shall not be available to person who has opted for so and so. So it's a clarification. 115 JE says that except as otherwise provided, just like 115 JB subsection 5 of MAT chapter, all the provisions of the Income Tax Act will apply to the person to whom AMT is applicable in addition to provisions of AMT. Meaning thereby, assessee cannot say why should I file IT return, why should I pay tax in advance, why should I pay health and education cess, why should I pay surcharge, AMT is applicable to me. No, AMT is just a calculation methodology for calculating tax in case of certain persons. Once tax is computed as per this chapter, all other provisions of Income Tax Act will continue to be applicable. Simply, the applicability of this chapter will not affect the applicability of other provisions of Income Tax Act. 115JEE subsection 1, subsection 2 and subsection 2A. Subsection 1 important, it says that AMT chapter will apply only to those people other than company, of course, only to those people who have claim. Person who has claim, chapter 6A deduction under heading C other than ATP, 10AA or 35AD. Person who has not claimed any of the three, then this chapter will not apply to him. For a small person like you and me, at least I don't know about you, but for a person like me, I don't claim heading C chapter 6A in any of the year. I don't have unit in SEZ. I don't have 35AD specified business. I don't happen to claim any of these. For a small person like me, chapter will not apply. Not only that, even if I have claim, then subsection 2 says that AMT chapter will not apply to individuals, HUF, AOP, BOI, AJP, 5 people unless and until ATI exceeds 20 lakhs. ATI does not exceed 20 lakh, then provisions of this chapter shall not apply. Now, okay, agreed, no issues. Then government said one more person, that was 115JEE subsection 1, subsection 2. Subsection 2A recently introduced by Nirmala Sitharamanji, specified fund. Specified fund referred to in 10(4)(d). What is specified fund? I explained it to you here sometimes back. Specified fund is same as FII, but it's just that it is incorporated in India. Then in such situation, AMT chapter will not apply. So 3 people it will not apply apart from company. Now proceeding further. Now subsection 2A is done. Now everywhere what government did, they said this chapter will not apply. Subsection 2, this chapter will not apply unless ATI exceeds 20 lakh. This chapter will not apply to specified fund. Agreed. But when government says whole chapter will not apply, that means not only AMT but even AMT credit also cannot be used or utilized. AMT credit will also lapse. However, this was not the intention of government. So what government did, they introduced subsection 3. Rather than changing the language here and removing the word chapter and introducing some other language, government introduced 115JEE subsection 3, stating that notwithstanding anything given here or here, the AMT credit will be available as it is. Notwithstanding anything, or irrespective of anything contained in these two subsections, credit of AMT shall be allowed in accordance with 115JD. That's it, chapter is over. Last part is 115JF definitions, which is not to be done. So in your notes, I've covered this chapter very briefly in one single slide. Everything is covered perfectly, comprehensively. Have a look at it. Just remember one thing, that out of these 3 deductions which are to be added back, that is chapter 6A heading C, other than ATP, 35AD and 10AA. Out of them, 10AA and chapter 6A heading C are allowed only if IT return is filed within the due date or extended due date. Otherwise, these two cannot be claimed. Remember it. And as far as rates are concerned, rate is 18.5%. Instead of 18.5%, will be 15% for cooperative society or 9% for unit of IFSC deriving income entirely in foreign currency. This thing you remember, it has already come in the form of MCQ, can be asked once again. With that, revision of this chapter comes to an end. Thank you very much. Wish you a very good luck. See you in the next video with some next chapter.